The equities markets are having another rough start to the week. The S&P 500 is down 0.8%. The Dow Jones is down more than 1%. The Nasdaq is also down. Gareth Soloway is joining us today. He is the chief market strategist at InTheMoney Stocks. Gareth, welcome back.
Hey, thanks so much for having me again, David. Thank you.
We're seeing interesting price action. So again, stocks are down. Gold is also down, but not a lot. Normally, you'd expect gold to hedge against such movements, but 2020 has been unpredictable for everything. So how are you reading this?
Yeah, so to me, it seems like as we come into the end of November that the markets are likely going to have a weaker December. And just to quickly frame this, and then we'll talk about gold, but basically you have a scenario where we've had a blockbuster in November. And a lot of stocks are at all-time highs or close to all-time highs, even with what's going on with COVID. So you have this big election coming up in early January. Now, normally the election results are all decided by the end of 2020, but we have this special election which will decide who takes control of the Senate. Republicans are favored heavily. But the thing is that you have many multi-million, even billionaire investors with tens of millions in gains, long-term capital gains. And the reason you could see selling in December is simply that these long-term cap gains, which are currently at the 15% tax rate, if the Democrats were to somehow squeak out a victory for both Senate seats and take control of the Senate, you would likely have a doubling of that long-term capital gains tax come 2021. So it's really Russian roulette for all of these people with big gains. Do you want to risk it, or do you want to sell your positions into the end of the year, guarantee yourself that long-term cap gains tax that's currently in there, and then you can always rebuy the positions 30 days later? Remember, that's the rule. You sell and you just have to wait 30 days to rebuy, and you don't have to risk paying double the tax on long-term capital gains. So if I was someone, and I'm a much shorter term trader, so most of my gains are short-term capital gains taxes. But if I was a long-term cap gains person with, 10 or 20 or 50 million in taxes, there's no way I would risk paying that doubling of a tax rate in 2021 on those gains. So my guess is you'll see weakness there in the markets into year end. Everyone always assumes a Santa Claus rally. I'm not necessarily in that camp.
What is a Santa Claus rally, Gareth?
Santa Claus rally is really, everyone gets jolly and everyone's feeling great. And, that's really what it is, so the markets tend to kind of float up into the end of the year. It's usually what happens, but we've seen certain instances like in 2018 where that didn't happen. In 2018, the Federal Reserve started to kind of hint at raising rates, and the market threw a major hissy fit. And the S&P and the Nasdaq collapsed close to 20% in just 6 weeks.
Okay. All right. So we're going to talk about charts and price action in just a minute, but I love talking macro with you. So we're going to start with that for now. So rotation out of the stocks is what you're saying into December because of a possible increase in capital gains taxes. Okay, that makes sense. Federal Reserve monetary policy. Let's talk about that. How do you feel about Janet Yellen being nominated for the Treasury?
I think it's the safe choice. It's the choice that gets more money into the economy. I also think it's a long-term detriment to the economy and to the U.S. You have a Federal Reserve that arguably has printed money every time there's been any sort of bubble or creation of bubble. You could say the Federal Reserve is actually the culprit behind it. If you look at the late 90s with the tech bubble, after that, they started to lower interest rates and put in easy lending practices, which enabled the housing market bubble. And then we know what happened with that one. And then now they've done it tenfold ever since that crisis leading into COVID, and printed even more money, pushed more money into the economy. Their balance sheet has expanded trillions and trillions of dollars this year alone. And Janet Yellen's a Fed chair. She's a former Fed chair. So you have the Federal Reserve on one side of the government and arguably the Federal Reserve on the other side of the government now, which is going to mean more and more money. So it's kind of short term, the markets probably like it. And I think we did see a rally when her name was first floated. But longer term, I really fear for the dollar. I really fear for the economic situation longer term with inflation.
So yeah, Gareth, let's talk about inflation. The last time we had quantitative easing, several rounds of QE throughout the last decade, money supply increased dramatically over the last 10 years. So if you look at the M2 money stock, which is what we're seeing now, in 2009, the money stock was about 8.4 trillion. Right before the start of the pandemic this year, so before unlimited QE this year, it was already at 15 trillion. So that's almost a doubling of the money supply over the last 10 years. Now, inflation has not risen exponentially. If you look at year over year inflation rates in the US, they've hovered around 0.7, 2%, 3% in 1 year in 2011, but nothing more than that. The expectation here from economists is that unlimited QE is going to create really high levels of inflation, but that hasn't happened last time in the last 10 years, has it?
No, it hasn't. The one thing to keep in mind with M2 is that it's usually a big lagging factor. So, especially when you have what we just went through with COVID and what we're still going through with COVID, you've seen people hoarding money. The savings rate has jumped. Anytime you get this scenario where people are more concerned about their livelihood, their jobs, the economy, people are going to put money away and not necessarily start buying things willy-nilly. So that creates a scenario where inflation in the short term stays muted, but longer term, it is going to bubble up. There's no way you can just print unlimited amounts of money, trillions and trillions and trillions a year, and not expect that inflation will bubble up. And the one thing of interest here is that if you look at the gold consolidation period, so if you go back to 1979, when we hit $875 on gold per ounce, there was a 30-year consolidation period before we took out those highs in 2008, right? And now if you look at the most recent high in 2011, just over 1900, it only took us, and this was in 2008, about 10 to 11, maybe 12 years to get back to those highs. So notice the 30-year amount of time that it took versus just about 10 to 11 years. And that's what we should be paying attention to. That's the expansion of M2 that's driving gold up much, much higher than what happened in the 70s and 80s.
Inflation, you said, wouldn't bubble up. It would bubble up because of this expansion of the money supply. Well, I'll give you a scenario in which it wouldn't. If nobody spends any money, if everyone's if everyone maintains their high savings rate from this year, let's talk about the savings rate from this year. So we saw a huge increase, a spike in the savings rate in April, then it dropped back down, not quite back at pre-COVID levels yet, but mirroring this is their personal consumption expenditures. Again, drop in April, spike back up, not quite at pre-COVID levels. The one thing that is at pre-COVID levels and actually beyond, surpassed that, is the retail sales. So this chart shows retail sales from the St. Louis Fed data surpassing pre-COVID levels. So spike down again in March, we're way back up. And, this goes back to my theory about people not spending money and not causing inflation. Well, I think my theory would be wrong because clearly people are spending money, right?
Yeah, in retail, people are shopping online. This is the thing too, right? So, just looking at my own family, we haven't gone out and taken big vacations. Usually every year we take one or two big vacations, spent $10,000, $20,000 on these vacations. We haven't done that, with COVID. What we have done is we bought my kids a big play structure for the backyard that was multiple thousands of dollars. We've bought more toys online. We've done more shopping online. So you're seeing the retail sales do really, really well because people are not spending that vacation money. Now the savings rate is up because the vacation money is so much that's being saved and only a portion of that is being spent on retail. So you do have a scenario there where in the short term, people are doing the retail spending, but they're not spending on vacations. And think about not traveling to work. People aren't buying lunch out at work, the gas in the car. I mean, there's so many ways that the average American are able to save money while still spending on retail. And again, that explains why retail sales have recovered so sharply. The one thing I will say is, I'm short Target right now, I'm short Best Buy, and you might say that's crazy going into the holidays, but you are going to see as we get closer to a vaccine, the expectation is that retail sales will actually dip probably even lower for a short amount of time to pre-COVID levels or even lower than that, just because people bought so much over this period that now they can take a little break. They're going to shift their money. And just like me, I told my wife, I said, honey, let's go away for a month to an all-inclusive. Let's just go nuts. We've been so confined in a house. Let's just go have fun and spend tons of money on this stuff because of that.
Right. So it's interesting. The savings rate has declined mainly because people have not bought big ticket purchases like vacations. But you think now we're going to see a rotation back into vacation items? Is that what you're saying? So cruise ships,
Absolutely.
airline stocks, are those going to do well then?
Yeah, yeah. I think, again, you got to be a little careful with the airline stocks like American Airlines. They've issued so much debt. There's still going to be, a long period here where people aren't going to get the vaccine just yet. I do think they survive, but in what form, that'll be the interesting thing. But in general, a Delta Airlines, a Southwest Airlines, I would be a buyer on dips at these points. Yeah, absolutely. Because you're going to see these vacations, these destinations and airlines, they're going to be overbooked because people want to go places so badly for a short amount of time. For 3 to 6 months after COVID, people are just going to want to go have fun. And I don't blame them. I think we're all in that position.
Right. What about the stimulus checks? Do you see more of that happening next year? Because a lot of the retail sales were sustained through stimulus checks this year.
That's right. That is right. That's a good question. I think that the Republicans, if they continue to control the Senate, will fight against any big stimulus, not only because they see the stock market near all-time highs and say, well, why do we need it, even though we know that, a good chunk of Americans don't have investments in stocks. But you also have the scenario where with that vaccine coming, they're anticipating a reopening surge in the economy, which you likely will get. The question is with so many small businesses going out of business, and even in the next 3 to 6 months, you're going to have a lot more going out of business. Will the recovery, when we see post-COVID, meaning that vaccines are administered and everything's back to normal, what will the economy look like? And that's a concern to me because the small business we know has been the backbone of this economy. And the big businesses have done great during this. The small businesses are struggling to survive. And without help, a lot of them will go under. So it's tricky. Now, just one little other tidbit here. You have the potential for that election in January shifting the balance of power in the Senate to the Democratic side. If that were to happen, you would see tax rates likely go up, but you'd also see massive stimulus. So a lot of people say, oh, if the Democrats take the Senate, it's going to be really bad for the stock market because tax rates are going to go up. In the short term, maybe, but I think once you start getting trillions and trillions of stimulus out there, the markets would likely come back off of that.
Yeah, okay. Let's talk about specific securities and assets now. Let's start with Bitcoin. This is interesting. Gold is trending down, but Bitcoin just hit all-time highs this morning. Well, it breached all-time highs, setting new records. The theory here is that a lot of the money is rotating out of gold into Bitcoin. I don't know if you see any correlation there.
I do see a little bit. I think, in general, this market is driven by smaller money right now, which is very about finding the hottest thing. And right now, it's the cool thing to be in Bitcoin, and it's going to continue to keep Bitcoin propped up. But I do think gold will remain a staple. I think gold will continue to be a safety asset that a lot of bigger investors want to have a holding in. I continue to hold 5% of my net worth in metals myself, along with 5% in Bitcoin. It's just been my security and insurance policy that I've felt comfortable with considering the periods we're going through. If you look at the Bitcoin chart, and you guys can see it on my chart here, is that we just hit that double top right here, just underneath 20,000. There's a chance that we could go as high as 22,700. The way I arrive at that target is very simple. If you look at the run that started in 2017 and topped out right underneath 20,000, it started around 1,000. So it went from 1,000 to about 19,750 or so, 19,500. And if you take that move, the distance of that move, which is about 18,000 and change, and if you look at the low this year at 3,900, and you add that distance up, the measured move would take you to 22,700. So even though I think I would never advise anyone at this point after such a massive run in Bitcoin to go long Bitcoin here, I do think if you're still in it, you could see it move up to about 22.7 before it really tops out. Now, once it tops out, I think you're going to get a pullback of significance. I think you probably head back to about 14,000. There's a small chance that you hit support here at 12,250, but the 14,000 level is the former pivot high from 2019. That'll work as a big support area. A lot of big money will come in there, including myself. I would start to accumulate some more there at that 14,000 level.
Yeah, so that chart was closely correlated with gold up until, I guess, 2 months ago until we saw a huge divergence. Bitcoin just continued to rally while gold fell. What's causing this? Well, first of all, do you think this positive correlation with gold and Bitcoin this year was at all warranted? Was it just a complete coincidence?
No, I think it's definitely warranted. I mean, you have a situation where Bitcoin is seeing new money, new institutional money, which is why I think it's decoupling a little bit here from gold. You have gold, which has been a long-term staple of everyone's portfolio, every hedge fund, every fund out there, and every big institution, and therefore it's going to trade more in line with the inverse of how the economic outlook is. So as we get closer to reopening, you're going to see gold, and we've seen it pull back beautifully here, pull back as well. The economy, the outlook of the economy is getting rosier. COVID vaccines coming. Okay, gold pull back. With Bitcoin, it's a little different because it's such a new asset, especially for funds and institutions, that even though they're seeing, even though we're seeing gold pull back, there's enough new money that's flowing into Bitcoin to keep it propped up in the short term. And we just heard from PayPal recently, they were buyers of about 70% of all new Bitcoins last month. So, I mean, that's why it's performed much, much better in the short term than gold. But there will be a longer term revisiting of that correlation where once you get the money in that needs to get into Bitcoin, it'll start trading along with gold again. And I'd love to just show a chart here on gold, guys. This is such a cool chart. I did some calculations on where to buy gold on this pullback. And this is just a fascinating little example here. So just going back to this 876 high in 1979 or so, if you look at this point, right over in 2008 or so, you pierced that all-time high of 876, and then you retraced 382 Fibonacci level, right? So 38.2% Fibonacci was the retrace. And what's so cool about this is that we are repeating this historic move almost to a T. So if you look at the high pivot here at 1910, we pierced the highs, we got above 2000, and now we're retracing. And the expectation is that you should get a retrace of a Fibonacci 382 again, and the buy level becomes $1,749, $1,750. What's amazing about that is just last night we hit, I think, a low of around 1767. So, I mean, we are so close. But for those of you guys that are students of history with me and love looking at these longer term charts, the parallels between what happened the last time it broke out and this time is just so cool. So cool. So bottom line is begin accumulating gold. Anything down in this 1750 level here is really, in my opinion, it's the beginning of the next move up to a probably close to 3,000 price target.
Okay, let's finally touch on the other hot securities, EVs. So Tesla, NIO, let's talk about that.
Oh yeah, what to say about those? They are amazing in their runs. They are also insanely overpriced. Like, just to put it in perspective, NIO earlier this year was on the borderline. They had basically drafted their bankruptcy letters. The stock was trading at $2 a share. And in the beginning of COVID, they were basically going to have to file for bankruptcy. The government came in there with a bailout, and the stock then proceeds to go up about 1,100% to where the current highs are. Now it's pulling back today, as it should. But just to put it in perspective, remember when the government here in the U.S. bailed out GM and Ford? That would be the same as if within 9 months of the government bailing out GM and Ford, if they had gone to a multi-trillion-dollar market cap. Just how crazy that is. And we're talking within months of getting bailed out from bankruptcy. So these stocks, they're the hot stocks. Everyone thinks it's the new thing. The valuation is not feasible. Tesla, you could argue that that's the biggest player in the room. So maybe that deserves a higher valuation. But these other stocks, folks, and again, there's a lot of people that are cult followers of these alternate energy stocks, these electric car makers. But they will ultimately come in back to earth. There's no other opportunity or option here. So it's just a matter of waiting it out. I happen to be short Tesla. I'm short NIO as well. I had XPEV short. We just took 13% gain on it today in one of my services. And that was just another car, alternate energy car player that fell down today. But over the next 6 months, I do expect those to come back to earth quite a bit.
I think the valuations, correct me if I'm wrong, but I think the valuations for some of these stocks aren't really based on current earnings. It's based on future projections of investors really, really optimistic expectations on the entire like paradigm shift towards EV, like an EV culture kind of thing. And so
Yes,
you're basically
I love that.
projecting, yeah.
Yeah, I love that. I mean, the story is I actually have an electric car, and I'm on the wait list for the Tesla Cybertruck. When it gets built. So I'm all about it. I'm huge on alternate energy. I have solar panels on my roof. But as an investor, especially one that's shorter term in terms of holding a swing trade for weeks or months, I look at them in terms of, okay, even if they were to grow, how fast would they have to grow over how many years to grow into these valuations? And then what ends up happening is that you see the Robinhood traders, which have really gotten involved in this market. They are the ones that have run these stocks up. And the bigger investors and the bigger traders are starting to look for pullbacks. And I'm not saying these stocks are going to zero. They're not. I mean, they're here to stay. But at some point, it has to have a pullback after, a 1,200% run, especially when you were borderline bankruptcy.
Yeah. I mean, are you evaluating these? One last question, I'll let you go. Are you evaluating these using automobile metrics or tech metrics here?
I think you have to do both. I think what it is it's a mid-level. So a stock like NEO doesn't really do the stuff that Tesla does in the energy or the solar side of things, although maybe they will in the future. But even with Tesla, you take what a valuation is for a high-tech growth company, and then you also take a valuation for a car company. And what I would do is I'd average them for a conservative view. And then pick that valuation and say, okay, what is it really trading at? These stocks are trading at, I think Tesla's trading at 15 to 20 times revenue numbers, not let alone earnings. It's 1,000 PE on the earnings. Can they grow earnings into that multiple to be reasonable in a short amount of time? Maybe. I think you have a lot of other things with Tesla too, like it's getting added to the S&P 500. So there's a lot of hope that that's going to drive it up as well, in terms of its valuation currently.
All right, Gareth, let's continue this for another time. Thanks very much for coming on the show today.
Hey, thanks so much, David. A lot of fun. Thank you so much. Have a great day.
Yeah, my pleasure as well. Thank you for watching Kitco News. I'm David Lin. Stay tuned.